So the big beautiful bill here. So this is our disclaimer. Basically, really all it says is don't implement anything. Don't tell your clients to implement anything without running it by their tax advisors. That's really what it is. Now, Capstan, essentially what we are is we're a specialty tax firm. We partner with taxpayers and CPAs to kind of maximize tax savings. And we do it in a couple of different areas. Again, we've got cost segregation, we've got the energy studies, and we do research and development tax credit studies. So those are our main focuses. We help with some other areas in there, which we'll go into, but those are predominantly, if you ask me what I do now, that's it. What I'm gonna do later, some of that stuff that we've been doing over the last couple of years, well, just got swept off with a new bill. So those will be expiring very soon as well. Now this is a good kind of idea as far as where Capstan is. We're headquartered right outside Philadelphia in a suburb called Dresher. Everywhere where you see people, we were remote way before COVID was cool to be remote. So then we've got a few people in Texas. I'm one of the couple here in Dallas. And then any states that are orange or have an orange dot is where we've done projects. So if you're keeping score, that's all 50 states there. So that's me. Everybody, I put a business card out there. If you have questions afterwards, please feel free that you can contact me for whatever reason. Okay. So let's just jump into it. This is kind of our loose agenda. We're going to spend a little more time on certain areas, a little less time in other areas. Again, if there's topics that are interesting to you, just stop. We'll go into more detail on that. But our current administration put in the largest tax reform that was done several years ago, the TCJA, and that was the biggest tax reform that hit the tax code since like the 60s. So it was so big and so sweeping that it made major changes in it. There was a lot of those things that were in that particular tax reform that were set to expire. Well, this OB3 kind of extended a lot of those, made a lot of those permanent. Not everything was, but a lot of those things were permanent. So the key here is if you have clients that could deal with any of these types of incentives, I would encourage you to have them reach out to their CPA, or if they have just general questions about the incentives, I can help as well. But just do their planning with their CPAs early. There's so much in this bill that's going to touch people that you might as well try to get your clients' questions answered as soon as possible versus waiting to the very end of it. Now, bonus depreciation. So bonus depreciation, if you're familiar with bonus depreciation, essentially kind of you look at cost segregation. So like if you look at cost segregation, you have like a building like this. Let's say you bought it for $11 million, you know the land's worth $1 million. Well, now you have on your depreciation schedule just a straight line that says building that's being depreciated over 39 years. What cost segregation does is basically break down that building into different components. So now you're going to have a line item for lights, windows, doors, whatever. And then we're going to quantify what those assets are worth. Some of those assets, instead of being depreciated over 39 years, can be depreciated over 5. Some over 7, and then any of the exterior improvements to the site itself are 15-year land improvements. Those are all items that can be bonus eligible. Now the difference is when you accelerate the depreciation, you accelerate those 3 categories into those terms. Bonus depreciation, if it applies, is how much of that you get to write off on year number 1, or write it off whenever you implement a cost segregation study, because you don't have to do it right away. Let's say you buy a property, you've got enough expenses where you don't have any tax liability, and you wait a couple of years to do your cost segregation study, you still get the bonus that was available when you first placed that property in service. So that's a good vehicle to kind of identify those assets. And again, back here, one of the things I'm going to point out here, that date right there is very similar to the dates we have here now with the we call it the OB3. With the one big beautiful bill. We're going to have a very similar transition to that as well. But essentially anything that you're depreciating that has a life of 20 years or less is now bonus eligible, and it's now permanently bonus eligible. So bonus depreciation's been around since 2001, and it's been up and down as far as different amounts or percentages. It's now 100%, which is fantastic for a lot of the real estate people. So, the one thing that it didn't do that everybody was hoping for was they were going to go back into, we had a 100% bonus from the end of 2017 through the end of 2022. Starting in 2023, that bonus depreciation started stepping down 20% each year. So everybody was hoping it was going to go back to 2023 and give a 100% bonus, and it did not. So unfortunately, we didn't get that. Now for clients that can't use a ton of the deductions, there's a one-time allocation they can choose to do is take 40%, which is the current bonus percentage for 2025 on the old rules. They can choose to do that if they don't need any additional deductions, or maybe this 100% bonus is just way too much. Now, 100% bonus applies to any property that's placed in service after January 19, 2025. And we're going to get into some other details on that in a couple of slides, but essentially, starting on January 20, 2025 is when bonus starts in there, but there's sort of a split scenario here because there's a couple of different, for the real estate folks, so whenever you sign your written binding contract, if that was before this date, your clients receive the 40% bonus rate. If your contract is signed after that, they get the 100% bonus rate. So can't really do much about it now in July, but those were the rules. That's the rules back then. Now this right here just talks about what I was talking about up here previously on that 9/27/2017 number that I pointed out a couple of slides ago, and we'll go into a little more detail on that. But here's the split bonus rate. So again, if it's before, on acquisitions, before that date, then you've got these two bonuses. Now this 2026 bonus is only if there's an extended closing period. I mean, I don't foresee anybody if it started in January of 2025, I can't imagine the closing is going to go into 2026, but it could. So they labeled that. So written binding contract's important as far as the dates there. Anything after that, basically 100% bonus applies. Now, new construction, they have something on new construction to where there's really no bright line test to kind of tell you, hey, what bonus rates are going to apply when it comes to my construction. So what there is there is a safe harbor for with the IRS that basically says when the customer has spent at least 10% of the construction budget, not the planning, not the design, actual hard construction, that'll tell you that is when actual work, what they call, is of a significant nature, and that's when you would be considered already placed in service. So then your bonus rate, if that 10% rule happened again before this date, you're on the old bonus rules. If you haven't spent that up until this date and it goes over, then you're on the 100% bonus rate for the OB3. Any questions on that?
So the question, let's say I sold a building, I've got a big gain in it, so 1031 it, buy something else.
Correct.
So my basis is going to roll forward. Is the bonus going to apply to the new acquisition, or because the depreciation before is not good?
Well, because that's a new acquisition. So in your case, it'll apply to the excess basis in the new property. So good thing. Anybody familiar with 1031 exchanges? Right. So when you do a 1031 exchange, basically you sell your old property, you basically exchange it into a new property. Basically, you kick your capital gains down the road. Now on that, one of the things that's required is, let's say I'm going to do two things. Let's say you did a cost segregation study in your original building, and then you roll into a 1031 exchange. You must do a cost segregation study on the new property, regardless of what your excess basis spend is on that new property, to make it like kind. But with the 1030, That's an important piece, and I'm surprised you didn't know about that, or nobody even said that. But it's a really important piece to make it like kind, because that's how you actually make in a 1031 exchange like kind. But 1031 exchanges, I just lost my train of thought on that.
The question would be, is this bonus eligible even though?
It is, because it's a new, your acquisition of that new property is that date. So that new date, so anything, again, so there's a long calculation your CPA does that comes up with that excess basis calculation. The bonus would apply to not the whole amount that you exchanged in, because if you already did a study, then you've already gotten your accelerated depreciation. If you didn't do a study, well, it's kind of like it's too late at this point. But any of the excess between your original sale price and that new price, you get bonus depreciation on that when you do a cost segregation study. So that's where you need to kind of go into the detail and do a cost segregation study to be able to carve out those particular assets to where you can apply bonus to them. Yeah. So these contracts are going to really be key for probably most of this year. Once it goes into next year, except for maybe new construction, you probably won't have any issues going into 2026, but 2025 is going to be one of those things where timing and contracts are really going to tell the story as far as which of those bonuses are applicable. This is that safe harbor I was telling you about. It's called work with significant nature, when more than 10% of the total cost of the property is basically being spent on construction. So that's where it starts there. So this will give you an idea of like the difference that 100% bonus makes. New construction auto dealership placed in service at the beginning of January, so it was 40% bonus that we had. This is what our engineers did as far as carving out the 5-year, 7-year, and 15-year assets, about 37% of that number there. So at 40% bonus rate, we're just shy of $1.4 million in tax savings on the first one. So now, if this was 100% here, that goes up to almost 2.9 million. So it's significant benefit to the clients that can utilize that. Now this is a new one. This really only applies to manufacturing facilities. So it's qualified production property. Basically, a portion of a U.S. non-residential real estate property that's originally used by the taxpayer as an integral part of the production activity. So really, when you look at this, let's just pull up this. And typically, we're looking at the areas that are manufacturing, production, or refining of personal property into products. Now, what you look at is let's say we have a building here. This part's warehouse. This part's office. And then this part right here is where we actually make our products. This qualified production property applies to just that component where you make your products. And essentially what you do is after you've done your cost segregation study accelerated to 5, 7, and 15-year assets, there could be some additional assets that are under roof here that were part of the overall building itself that you can carve out in addition to. Now this is a temporary benefit that goes from basically that 1/20/2025 until the end of 2029. Next administration is essentially what it is. So for manufacturing, because really when you think about the new administration, they were really pushing for manufacturing to be back in the United States. So that was one of the benefits that they helped drive, is allowing them to write off more of the real estate that they're either constructing or purchasing during that time period. Now there's a couple of different things in here. Construction, as long as it started before then, it's great. Every property needs to be placed in service. And why they always say it must be placed in service before this instead of just saying place it in service by 12/31/2030. But anyway, so by this date, it needs to be placed in service. When it comes to acquisitions of a property, I don't understand these dates, and they haven't really said as far as these dates, but essentially what they mean is you cannot, as a business, go and acquire, say, an existing manufacturing facility that has been used in an active production activity during this time period. Now, if you're an owner of the real estate and you lease that out to like your tenant and your tenant was using it, then as an owner, let's say the tenant left and then during this time period you built something else, then you could technically yourself take advantage of the qualified production property. It's going to be pretty rare that you have just straight real estate investors in a manufacturing facility, but that is a scenario that could potentially happen. Typically it's not, but this is definitely something. And one other thing, very rarely in the tax code are you required to really file something timely and basically say that it's a timely deduction. This is only a timely deduction, so it must be filed. You cannot, where you can go back in time and do your cost segregation study that you didn't do, say, a couple of years ago. If you did not make this election in the original year, you can't make it after the fact. So this is where, exactly is what it's talking about. This is where you're going to be able to expense some additional components of the shell. It's a huge win. Honestly, I was having a conversation with a CPA earlier today, and likely it's going to be a huge win for those billion-dollar manufacturers, not necessarily like the $40 million or $50 million. It's just they're not going to have those expenditures in that time period. And then this is our depreciation accelerator. Kind of gives you an idea what things look like from a bonus standpoint, expensing standpoint. Our normal one goes back to 01. This one, for illustration purposes, only goes back to 2020. Essentially, this shows where we had the 100% bonus. This is where it's stepping down. And then this, oops. There we go. This section right here is where I was talking about the written and binding contracts and the construction dates. These two areas, these 2 years, are where you really want to focus on that, especially on construction. Because that's where it's going to likely lead into 2026. So these areas, now technically, even though it says for just these, it could go into 2027 if there was a long construction period or something like that. But likely, this is the only thing that we're talking about here as far as the years that are likely going to be affected by these requirements. Okay, so anybody ever deal with research and development tax credits or have clients that have dealt with that? Okay, so research and development tax credits are basically, it's a dollar for dollar tax credit towards companies that are actually doing innovative type of things where they're either technology, they're building widgets, whatever those are, from software to actual hard products. Anybody that's in the manufacturing side of things or even software development, let's say metal fabrication, things of that nature, you can actually qualify for a credit that allows you to basically receive a dollar for dollar federal business tax credit to offset your federal taxes. Some states, like Texas, actually has additional state credits you can take after that. But one of the things that was a limitation, what they used to do, the way the rules were, when I say used to, in 2021 is when the research and development industry was normal. So essentially what happened is these 174 assets, you have your research and development expenses, which typically range in here. So if you have wages of people actually doing the work, supervisors, support staff, you've got any sort of third-party contractors, any sort of supply costs, if you're making an actual widget that go into this. So that's this. These 174 expenses encompass these, but also add in these. So what was happening is, in 2021, you used to write all those expenses off on a yearly basis as you incurred them. What happened in starting in 2022, is let's say you had $1 million of these 174 expenses. Instead of writing off that $1 million in 22, you had to amortize that over 5 years. Technically, it's over about 6 years. Because you got 10% of that write-off in year number 1, then 20% for the next 4 years, and then 10% on the 6th year. So you can imagine, if you're used to have $1 million in deductions, and you now have $100,000, that causes a skyrocket in tax liability. Like, I had CPAs that had clients calling them crying, because one of the CPAs just told me about 2 weeks ago, the client was going to have to basically liquidate a lot of his assets just to pay the additional tax for this. And this was something that was part of the original TCJA and kind of how they balanced it. The problem is everybody in the industry, everybody in Congress, everybody around kept saying, well, we know it's there, but it's going to get fixed before it really goes into place. It never did. It just got fixed a few weeks ago. So for 3 years, you had clients that were used to taking their deductions, generating a credit, and really paying, really receiving tremendous benefit through research and development. They were now basically paying more tax because they had originally taken that. And there was a lot of clients that maybe they were manufacturers that all of a sudden said, oh, well, we no longer make anything. We're not gonna amortize these expenses because we don't make anything. Well, you've already raised your hand from the IRS. You've already been taking that research and development tax credit, so that wasn't something that was going to legitimately last for a long period of time. But you had a lot of clients that were basically saying stuff like that. So this issue that caused all this extra tax has now been repealed permanently. So hopefully we don't run into this issue anymore. But this again was a major issue. So now if you have that amortization had both domestic and foreign R&D tax or R&D expenses required as far as amortization. Your foreign is still untouched. It needs to be amortized over 15 years. But any sort of domestic, it's got to be based in a U.S. or U.S. territory as far as where that work is being done for. Now, the good thing about it is because we started amortizing these costs in 22, we're now in the 3rd year. There's a couple of different ways that this bill has allowed these clients to actually satisfy that. One is starting basically in 2025 tax year to be filed in 2026. They can either basically write off the last couple of years of their amortization, either in 1 year or over 2 years, depending on what they want to do. And so it's meant to mitigate more the future issue with the R&D tax credits, but it's not going to help in those previous years. Now, small businesses, for those of you that mentioned that you work with smaller businesses, there is a provision to where if their average gross receipts are under 31 million during that time period, they can actually go back into 22, 23, and technically we're waiting for guidance to see what they have to do in 24, because technically if this right here, it says after the first tax year after that date, where we're after it, but technically they should still, as they're filing their tax return, they still should amortize those costs. And then 4 months from now, they can go and amend it and get it all back, which kind of seems silly. So we're hoping there's a little more guidance to say, no, you don't need to do that, because we already know that it's been repealed. So from a functional standpoint, why would you do that? It must be done if you're going to go back in, and if you're going to be a small business and go back in and amend those tax returns to reclaim those deductions. It must be done by basically 1 year from now. So we always say June 30th, 2026 is probably that date, because it'll put it just before the bill is signed and put you into that. And you need to amend each year that you're taking advantage of that. Now again, this is where I was just talking about. We're waiting for some guidance to see if there is a way of doing this. Because you have a lot of, especially with this amortization, you've had a lot of people that are taking R&D tax credits that have kind of been sitting on the sidelines, and they extend, hoping for something that just happened to happen. It did, but it didn't address, well, what happened if I file an extension? Technically, I already know it's gone. What do I do? So right now, we're waiting for that. So this just kind of gives you an idea from kind of like the marginal impact. This is more of a pass-through type of entity. 2021, this is kind of what it looked like before. You had your 174 expenses you're writing off, and you're getting a credit. So essentially, you basically really pay less in tax. You actually had a negative in there. With that amortization starting here and going through, well, technically going through all there, that same year, if everything was equal, because of that amortization, you only got 10% of your write-off, it caused basically about a $400,000 swing between 21 and 22, with virtually the very same type of expenditures and numbers across the board. So that was this is what people were talking about, is all of a sudden, I've got a $400,000 swing and I've got to pay for that. That's what the issue was with that. And as you're doing this, because you're having a little more amortization from the year before, it steps down. Now this is basically an example of them just writing off the remaining amortized cost in 2025 and kind of how it's looking, because you're going to have your normal expenses, but then this will carry through on there as well. Kind of looks at it from a holistic standpoint again, here, there, and then you've got all your additional expenses there. Same type of scenario there. Now in a C Corp, because their tax rate is only 21%, it wasn't nearly as bad for them, and they kind of were made whole a little sooner on there, but very similar type of example to where, you know, their expenses were here, we went out to in tax there, we kind of normalized it, and it's still looking the same kind of going forward. Now, Section 179 expensing, this is more for your CPAs, to where if you're doing improvements to non-residential properties, not just commercial, because when a multifamily property is 4 stories or larger, it's considered commercial. So it's only for non-residential commercial properties, where you can basically deduct the full purchase up to a cap, and then there's an actual limitation on there as well. But these are some of the basic, there's a lot more to it than that, but these are some of the more readily written off assets on here. These were new as far as the TCJA, but again, these are specific to non-residential, especially this qualified improvement property. That's improvements to the interior portion of your building. It's not expanding it or taking out like low-bearing walls or something like that. But if you were moving the space around here, yeah, you'd be able to do that. And this is a 15-year asset that you'd write off 100% in this time period. But this is what that expensing limit looked like. So essentially, starting in 2018, anything up to $1 million, you basically just expense. Now, we're a cost segregation study. For those of you that are familiar with that, you can accelerate the deductions to basically actually put yourself into a loss. This, you can only go down to 0. So you cannot go into use 179 and actually go negative. You can just bring it down to 0. But if you're implementing a cost segregation study, from a functional standpoint, is you use your 179 expensing to bring it down to 0, then layer on your cost segregation study to bring you down into even more of a loss that you can utilize for tax savings. So this was 1.25, it doubled. This phase out threshold right here, essentially once you exceed this top line, after you exceed that, it basically starts reducing the benefit dollar for dollar after that fact. But again, this is more of like your CPA, a CPA tool. Now again, to see if most of this stuff is really geared towards CPA. So we would tell a CPA, hey, listen, don't just ask is it residential. Is it commercial? Ask if it's non-residential. There's some categories in the TCJA that this applies to. And then key here is they really want material participation in the business, but if there's an actual trade or business involved, like even somebody with an Airbnb, to qualify for an Airbnb and the tax incentives there, you have to have some sort of trade or business. So you operate it very much like a bed and breakfast or a small little hotel, your little Airbnb. Those types of avenues would would qualify. And there's never been any court cases on this. So for you litigators out there, if you want to litigate this, it's wide open territory for you. So this is a residential tax credit for developers of single-family homes or multifamily. We're going to kind of jump ahead a little bit, because this one right here, your clients need to be basically going to Energy Star and getting their properties Energy Star certified to be able to take advantage of it. It used to be you had to come to somebody like us to help do like energy modeling, see if they qualified. Now what they have to do is just go to Energy Star, get Energy Star certified, and if they get that certification, that's when they get their credits. Now the only difference is this has been around for a while. For credits that were generated in 2022 or before, it was $2,000 per unit. With the Inflation Reduction Act, it actually, if you were paying prevailing wages and had some apprenticeship hours in there, you could get up to $5,000 per unit tax credit. That's going to sunset. You're going to see that date pretty often. That's when that's going to sunset now. It used to be it was going to sunset in 2032. So again, the new administration came, Inflation Reduction Act, just a white scraping extends. Now this one, it's a long name, 30C. Key here, it's really about electric vehicle recharging. That's what you see mostly. You can say all these other things, but that's really all we've seen over the last several years, is somebody building these charging stations. Now, one of the benefits about it is you have a base credit of this, depending on if you paid prevailing wages to the people that are actually constructing it, that 6% goes up to 30%. And it's limited to a $100,000 credit for each property subject to depreciation, meaning each charging station can generate up to a $100,000 credit. So we've seen a lot of people make that their business. Hey, there's some good benefits there. Again, this one is going to sunset in that January or that June 30th, 2026. Now, the good thing about it is you can, not only do you get the credit, but it's also depreciable. So if it's part of, like, say, a multifamily where you have a couple of those in there, do a cost segregation study. We identify those numbers and help you identify the actual amounts that you can apply the credits. So where 179 before was an expensing mechanism, this is an energy efficient commercial building deduction. So what this would do is going back to that same example of cost segregation study. After we did all this, we still had some assets that were depreciating over 39 years. What this does is any of the interior lighting, HVAC and building envelope, basically this would allow you to carve out, which are all 39-year assets, would carve out more of that 39-year depreciation and accelerate that. So from 06 to the end of 2022, when 06 is when it was first brought to the table, and in 2022 that number was $1.80 a square foot. Since then, it's been, with the Inflation Reduction Act, it increased it up to $5 a square foot plus inflation adjustment. So technically this year, it's up to $5.81 a square foot. And so that's for building owners. So building owners, like I had a auto dealership client of mine that let's see, they did theirs, I think it was 08 is when they placed it in service. It was a LEED Platinum building. If you don't know what LEED is, it was super energy efficient. They did a cost segregation study. That's what a lot of auto dealerships do. But one of the things they were looking at is when I got introduced to it, was about 6 years after the fact, and they were looking for ways of finding more deductions. And so we talked about 179D. So we actually went back as of the original year that they placed it in service, calculated out the 179D deductions. And then this is a mechanism that allows you, this IRS Form 3115 basically tells the IRS, for the history of my property, I was depreciating straight line over this time period. Now implementing a cost segregation study or a 179D deduction on this property, now these assets are going to be depreciated over 5, these are over 7, these are over 15, and then I'm going to take my energy efficient deductions from 179D all in this current tax year versus having to amend it. So it's a very clean way of still accelerating depreciation, taking advantage of bonus, but not having the cost or the hassle of amending a return. Now, where do you see this? Be nice if this was where it really went most of the time. Where you see most of it is architects, engineers, or design build contractors that are designing and building publicly owned or nonprofit buildings. So anything that are owned by the public or nonprofit, because they're tax exempt, they can allocate that same $5.81 a square foot deductions over to the primary designer of the building. So I tell people it's basically like a legal bribe to have the architect or engineer really push the energy efficient boundaries, because the whole point of this is energy efficiency on the building. So by really having them do everything they possibly can, those deductions were their reward for kind of making that as energy efficient as possible. Again, the deductions were per square foot. So obviously the bigger the building, the better. And what we do is we take the design and compare it to a baseline standard. So right now that baseline standard it's called the 2007 ASHRAE standard, which is an energy code from 2007. All you need to know about that is that energy code was still prescribing fluorescent lighting as the main lighting. Now there is not a single energy code in the country that doesn't do LEDs. And when you think about it, like the first time when you first started hearing about LEDs, like they were like 10% of the cost from a energy standpoint compared to those fluorescents. So that's why they did that. So we're still comparing a really outdated energy code to these new designs. So pretty much anybody's going to qualify on this, no matter where it's located. But again, those big numbers, you have to have some sort of prevailing wage or apprenticeship requirements. So like I do a lot of business up in Illinois. So they're a union state. We do a lot of stuff up there. Texas, unless you're doing a publicly owned building, there's not a ton of basically union wages that are being paid. So you don't see that $5.81 per square foot really happening there unless it's a publicly owned one. Most of the time, instead of $5.81, if you're not paying prevailing wages, the max would end up being like $1.13 a square foot. So it's really a significant change between that. So again, they had this. It's now set to sunset. Now for the last 20 years, since 06, if anybody ever heard like tax extenders, you have all these bills and all that, and there was some tax incentives that basically got extended every year, every couple of years. This was one of them. We're likely thinking that this is going to go back because this has always had bipartisan support. So since it was enacted, so there's no reason why to say. And technically, it's been for the last 3 years. It's been a permanent part of the tax code. So you would think that it's still going to be there. We don't know. How am I doing on time? That's not right, correct?
12:47.
All right, cool. Yeah, I was going to say. All right, we're good. So the investment tax credit, or the clean electricity investment credit, essentially we call it the solar credit. That's really what most people did. Is they commonly utilize that credit for solar, but it would do geothermal, wind, or something like that. But typically, what you saw was solar. So it's a dollar for dollar credit on there. Now it can be claimed by basically any business that installs, develops, and/or finances a renewable system. So on some of the buildings, you see some of your clients coming in, and whether they're a homeowner or whether they're a business, if they're leasing their equipment, they're not depreciating it, so the credit would go back to that developer that's putting it on there, that's basically carrying the debt. If they did buy it, then they would be subject to the credits. So it really depends on who really owns this, is who gets the credit going forward. And it applies to equipment and installation. And really the nuances are really not much different, but it's called ITC if it was started before January 1st of this year, or afterwards it's this. And then this will terminate in 2027. Now one of we'll go into our dates again here. So as long as construction began before the bill is enacted, then it's here. And then afterwards, as long as it's placed in service by this, they can still put in the full credit. Okay, now the only difference with this is there's a domestic content requirement. So they wanted more of these components coming from the United States. So the later in that time period that construction starts, the higher that percentage of domestic content is required. That's all. This one also, with solar credits, companies can sell those. Like the SRECs or something like that. If you've ever heard of SRECs, those are the little credits that are generated by solar. Those can be sold. Those can be transferred through the end of 2028. And there's a whole little industry there. There's a whole industry. So I'm not even going to go into that. It's a big industry where they do sell those things. For any of you small business owners or even deal with small businesses, the Section 199, the QBI deduction, we're probably all familiar with that. The House tried to boost it up to 23%. They went with the Senate version where it's still 20%, but it's now permanent. Before it was just on a year-by-year basis, so it's now permanent deduction. And really that was meant to kind of level the playing field between the low 21% tax rate for C Corps, and at the highest on individuals, you're looking at 37% tax rate on partnerships or S Corps. So that was meant to kind of bring that a little closer. It's not going to ever get close to the 21% for C Corps, but it was something to try to help. You must have basically a qualified trade or business, and there's a list of those, and there's a ton of businesses that qualify. And there are income thresholds that apply to basically limit this on here. Now this, again, this is more of a CPA thing, but this business interest deduction, it's essentially it's a limitation of basically the interest that they can take. You look at the business interest income and then basically the adjusted taxable income, and it used to be that basically we looked at this model for predominantly most of the time period. During the Inflation Reduction Act, they actually went to this model. The difference is the depreciation and amortization couldn't be added back here where it could there. So obviously if you're adding this back into here, this is going to give you a higher limitation on that. And then basically limited there, and now basically this is now permanent as far as the tax code. So companies with large capital expenditures are good. Companies are making long-term investments. Basically, this helps them out a lot. Those are really the focus, kind of bigger companies versus the smaller companies. But again, a switch date. This was this. My marketing people like to have me click a lot. So now, qualified opportunity zones. Anybody ever dealt with those? Yeah, I mean we've probably heard about them. So basically, qualified opportunity zones, you can actually invest in those particular properties, and most of the time there are multifamily developments that were happening. And these qualified opportunity zones, the whole goal was to go into more lower income kind of areas to where they were kind of struggling more from a financial side of things, and try to basically bring in nice properties and kind of raise the overall value of that area. Well, what you saw this last little, since it's originally enacted a few years ago, was you'd have say that multifamily, the front of that basically, forward facing maybe the lower income area, but if you went out the back door, you're going into Highland Park kind of thing. And so it wasn't really helping those more distressed areas. No, it was basically they were still putting them in very desirable areas. And so it was what they've said with this new bill is they're going to make it to where it's actually got to help what it was it was originally intended to help, is those lower income areas that needed a little bit more to bring them up. So it's a temporary tax deferral. So you get a step up in basis in your original investment. So if you hold at least 5 years, you get a 10% increase. So only 90% of your deferred gains are taxed. That's not bad. If it's rural opportunity zone, that increases from 10 to 30%. But if you hold investment for 10 years, there's no post-capital gains on that gain from that investment. So it's huge. That's a big one. So you saw there's a lot of different assets that can go into there. Let's say you're selling something like, there's people who are selling stock, or if you're doing like an exchange or something, like exchanging or something like that. It's like, this is huge on the capital gain side of things. So now all of this is just a chart. I think I gave Taylor, if not, I'll make sure I give Taylor a copy of the overall slides that we have here. We'll get a PDF. But this is a good one to kind of give you an idea as far as what's out there, time period, stuff like that. But really how to make the most of this is, again, it's CPA focused. So if you've got clients that you're advising, just have them talk to the CPAs or have them talk to, I don't care what they're doing, give the CPAs that information, because a lot of times you'll have a CPA that doesn't know what's going on, and then all of a sudden, a month before tax deadline, they go, oh yeah, I just bought a building. Or I just did something like this out of really without informing them. Technically, if it had anything to do with money or their business, they should be telling their CPA as soon as they're doing it, or even before. But have those CPAs review those things. Look for capital investments that have happened, or any sort of research activity, any sort of real estate deals on there, manufacturing clients, and then model out the scenarios they get in their top tax software. They can basically kind of fill in and let them know, hey, listen, if I have this amount of deductions, what is it going to do for me from a tax perspective? That's a plug for us. Do cost segregation studies. They are very helpful, and that's the only way to really carve that stuff out. It's like, how would you know what these lights are worth? I don't know. Well, we do. We can actually go through and quantify that. And the difference here is, when you think about this, is these camp lights, those are typically the required lighting for this space. So those would be 39 years. For these two LEDs, and then all the wiring back to the junction box, are 5-year assets. You think we're on the 10th floor. I don't know where the junction box is, but likely it's somewhere south of us. So that could be a serious expense. So what we do is we quantify all of this stuff in the building and the cost segregations, and review the R&D expenses for those years if you're especially if you're a small business. Basically energy stuff for timing. Key here is the stakeholders, anybody that's in charge of their business or their assets. Have those conversations with your CPAs to kind of just really make sure that, because there's, like I said, there's so many other components to this bill that we haven't even covered. Get with your CPAs early, talk to them, say, hey, listen, what can apply to us? Because there's a lot of moving parts in there. So there may be some things that weren't necessarily even around beforehand, or maybe didn't apply to you beforehand, that could then.